If you're the CFO of a U.S. company with operations in Canada, or you're planning to expand up here, this is not the year to be winging it. Because here's the thing, can't retroactively tax plan your way out of bad structure, bad documentation, or missed opportunities. Hey, I'm Duncan McPherson and welcome back to my channel. I'm a dual qualified CPA in both Canada and the United States, and today I'm going to walk you through 5 strategies that every CFO needs to lock in if you want to protect your profits and reduce your risk and stay ahead of what's coming in 2026 and 2027. So let's get into it. There are 5 key strategies that I want to walk you through in this video. Number 1, how to structure your Canadian operations the right way from day one. Number 2, why bookkeeping will make or break your tax strategies. Number 3, the smartest ways to move profits out of Canada tax efficiently. Number 4, what most CFOs miss when it comes to GILTI tax exposure. And strategy number 5, how to charge intercompany services without triggering CRA penalties. Let's start at the top. Strategy number 1, you need to structure your Canadian entry with the end result in mind. I've seen way too many companies jump into Canada and set up the wrong entity. And I get it, you're eager to get moving, but operating a Canadian branch or a Canadian corporation has ripple effects. Ripple effects across income reporting, loss utilization, treaty benefits, and future restructuring costs. If you plan to treat your Canadian entity as a disregarded entity in the future for U.S. tax purposes, you need a ULC from the get-go. ULCs qualify for check-the-box treatment in the United States, but Canadian C corporations do not. So even if you don't care about check-the-box now, you might in the future. Go with the ULC. In the United States, you can treat it as a corporation from the get-go, or in the future, check the box and make it a disregarded entity. That's what you need to do in the future. Get this part right from the beginning, or you're going to be paying a lot of legal and accounting fees in the future. Strategy number 2, your tax plan is only as strong as your books and records, period. If your books and records are messy, behind, or overly summarized, none of the smart strategies I'm about to share will save you. CRA's audit system is driven by algorithm. If something looks off, you're going to get flagged and fast. So if you're running a payroll, contractor payments, or intercompany charges, every single dollar needs to be backed up. I have seen companies spend tens of thousands of dollars cleaning up sloppiness that could have been avoided with a little bit of diligent bookkeeping. Clean books and records are not optional anymore. Strategy number 3, you want to repatriate your profits from Canada to the United States. You need a strategy, not a guess. Here's one of the smartest ways to do it. Capitalize your Canadian operations with an intercompany loan. Why? Because interest on that loan can move to the United States with no Canadian withholding tax, and the interest is deductible in Canada, if and only if it's structured like a real loan. That means fair market value interest, legally enforceable repayment terms, and a signed loan agreement in place from day one. If CRA senses that the loan is just an unpapered understanding, they'll recharacterize it. They'll deny the interest deduction, and suddenly your strategy is a liability. So do it right or don't do it at all. Strategy number 4, if you're not aligning your depreciation rates between Canada and the United States, you could be walking into a GILTI trap. Canada allows huge bonus depreciation. Great, right? Well, not if it triggers a mismatch with your US ADS calculations and causes your E&P to balloon beyond the high tax exception threshold. And suddenly you're paying GILTI tax on Canadian profits that you already paid tax on in Canada. This is the classic definition of a lose-lose. It's double taxation with no relief. What we do for our clients, we adjust the Canadian depreciation to make sure that it matches with the ADS. We can do that up here. Depreciation is an optional deduction in Canada. There are other strategies we use up here to avoid the GILTI tax. That's just one of them. Our strategies keep things congruent and it keeps you out of GILTI trouble. Because I promise you, you do not want to find out in year 5 that you've been doing it wrong since year 1 and get nailed with the GILTI tax. Strategy number 5, if you're billing for intercompany services, get your documentation airtight. Yes, you can charge your Canadian company for services provided by the US parent and avoid withholding tax on these payments. And yes, those charges can be fully deductible in Canada, but only if they're real, itemized, charged at fair market value, and fully documented. The days are gone when we used to pay blanket management fees and hope for the best. best is a really bad idea in today's tax environment in Canada. They will catch you. And those management fees, if they're not documented, they're not at fair value, and all the other things that I've said, they're subject to 25% withholding tax. What you need to avoid this is what I call a complete circle of documentation, which in this case would include a signed contract between entities, itemized invoices, fair market pricing, payment terms that match reality, and backup for all of this. Do that and CRA tends to back off. Don't do it and you'll have problems. Bottom line, 2026 is not the year to wait and see and hope for the best. If your U.S. company has operations in Canada or you plan to expand up here, now is the time to get things right. So here's what you do next. Go to the MacTax.com and have a look at the free CFO toolkit. It's packed with everything we talked about today, including entity setup guides, lists of legal work, intercompany checklists, all of it right there at your fingertips. And if you want help building your custom plan, reach out to book a no-cost cross-border tax strategy call with me. We'll go over exactly what to do in your situation so you're protected, efficient, and fully in control. Until next time, I'm Duncan McPherson. Stay sharp, stay compliant, and please stay out of tax trouble. And I'll see you on the next video.